India's bond market is vast, worth over 226 lakh crore rupees, equivalent to approximately 2.6 trillion United States dollars. For decades, it was a closed shop, a playground for large institutions like banks and insurers, with everyday investors watching from the sidelines. Now, with a wave of groundbreaking reforms from SEBI, that is all changing. The bond market is opening up and a revolution is underway. What is happening and what does it mean for your money? In this video, you will learn why the bond market has been so hard to access, the 3 key reforms SEBI is using to democratize bonds, and the critical risks and opportunities for you, the retail investor, in this new financial landscape. By the end, you will understand how to think about bonds not as a distant, complex topic, but as a potential core part of a diversified portfolio. If you are a finance professional looking for deeper research-backed insights, or a curious saver who wants to understand the forces shaping the economy, consider subscribing. We simplify complex financial topics with a clear, story-driven approach. For years, the problem was that India's bond market was not built for individuals. It was designed for a handful of powerful institutions. Imagine a massive high-end department store that only allows corporate buyers with minimum purchase orders of 10 lakh rupees. The prices are not listed, the store layout is confusing, and you cannot easily return an item if you change your mind. That was the experience for bond investors. As a result, institutions held over 96% of corporate bonds, while retail participation was minuscule. But a perfect storm of factors has created the ideal moment for change. On the one hand, investor demand is surging. With the Reserve Bank of India cutting the repo rate, traditional bank fixed deposits offer lower returns. Investors are hunting for stable, inflation-beating alternatives. On the other hand, technology has made it possible to build a better system. We have seen how fintech firms have made buying stocks and mutual funds a one-click process. Now, the same is happening for bonds. SEBI recognized this moment and launched a multi-pronged attack on the old system. The goal? To make bonds as simple to buy and sell as shares. The first major change is an incredible reduction in the minimum investment. For privately placed bonds, SEBI slashed the entry ticket to 10,000 rupees. Some bond issues can now be purchased for as little as 1,000 rupees. This change brings many more investors into the fold. It means you no longer need to be a high net worth individual to access this asset class. The second change is the creation of a brand new digital ecosystem. SEBI introduced a formal licensing framework for online bond platform providers, or OBPPs. These are fintech apps that can legally sell bonds to retail investors. Think of them as the Zerodhas or Upstoxes of the bond world. There are now, in the mid to late 20s, such platforms, bringing user-friendly interfaces and robust data to a market that was once dominated by phone calls and paperwork. Crucially, all trades now settle on a recognized stock exchange, bringing the same transparency and trade plus one-day settlement that equity traders take for granted. This shift eliminates opaque over-the-counter trades and builds trust. The third and perhaps most innovative reform is the focus on liquidity and safety. Historically, if you bought a corporate bond and needed to sell it before maturity, you were out of luck. The secondary market was tiny and illiquid. To address this, SEBI now allows issuers to create special liquidity windows. A company raising debt can commit to buying back bonds from retail investors after a few years, giving you a guaranteed exit path. This is a powerful new tool. SEBI is also mandating enhanced disclosures and compulsory credit ratings for any bonds sold in small lots to individuals, a measure designed to protect retail investors from complex or risky products. Taken together, these 3 pillars, lower minimums, digital platforms, and enhanced safety, are a powerful force. India is not alone in this effort. The United States has a system called Treasury Direct that allows anyone to buy government bonds directly, and Singapore has a similar system for retail savings bonds. India's new bond ecosystem mirrors the best practices from around the world, making the product accessible, transparent, and trustworthy. Of course, with opportunity comes risk. You must be aware of them. First, credit risk. A corporate bond is not a fixed deposit. A company can default on its payments. While SEBI's rules mandate credit ratings, you still need to understand that higher yields often mean higher risk. For investment-grade bonds rated BBB, Multi-year default rates globally are around 0.35 to 0.5%, not over 2%. Second, liquidity risk. Even with new exit windows, the secondary market for bonds is still less liquid than the market for stocks. If you need to sell quickly in a downturn, it may be difficult. Finally, interest rate risk. Bond prices move inversely to interest rates. If you lock in a bond today and the Reserve Bank of India unexpectedly hikes rates, the price of your bond could fall on the open market. Bonds are a longer-term investment, and understanding this relationship is key. In the end, this is a once-in-a-generation shift. Bonds, once the neglected cousin of equities, are stepping into the spotlight. Thanks to SEBI, they are becoming an accessible tool for everyday investors, not just institutions. The old barriers are gone, and a new, more inclusive market is emerging. This means a new opportunity for you to diversify your portfolio, lock in stable income, and build wealth with an asset class that was previously out of reach. If you found this deep dive into India's bond market revolution insightful and want more content like this, be sure to hit the subscribe button and the notification bell. We will see you in the next video.